Hey everyone, it's Nick with Us versus Herd. If it's your first time here and you're enjoying the content, hit subscribe. If you want to get notifications for when we go live or when we post videos, tap the bell. Really appreciate it. We're going to be going through an introduction to Robinhood options trading. If you know what options trading is, if you've been trading options, you kind of already know, or you just need a refresher. This is primarily for the people that got an email from Robinhood saying, "Hey, start options trading, options trading today," but you have no idea what options trading is. So I'm going to just go through the basics. This is for the beginners. We're going to do very basics. We're going to be going through what an option is, calls, puts, etc., etc., etc. Anyways, so I'm on the Robinhood web version, pretty much the same on your mobile. From look, feel, and what you can do with it. It's just a lot easier to show on the screen on the computer than it is scrolling through your phone for this little tutorial. So what I'm going to do, how to get to the options is I'm going to do Apple. This is my watch list. You can obviously look up any stock that you want up here in the search bar. Let's say you want to look at Netflix, or you want to look at GM or Ford. You can pretty much look up any stock that you want here. But since I already have some on my watch list, I'm just going to go off of this. I'm going to go to Apple, and when you click on the stock, you're going to find this little button down here. It says Trade Options. By default, they want you to buy and sell stock. Because primarily that's what Robinhood is known for, just buying and selling stock. And recently they allowed options trading on it. So what you want to do is on here it says. On this button here, it says Trade Apple Options. You want to click on that, and that will bring you to this page. And it gets a little confusing, especially if you're new. You're like, okay, there's all these numbers. It says buy call. I thought I was buying Apple. This is a strike price. It says it expires. What is going on here? So we're just going to go through some of the basics here real quick. If you have and this is for people that have no idea what options are, or just starting out in options. If you're an experienced options trader, video is not for you. So what is a stock option? So a stock option gives an investor the right, but not the obligation to buy or sell a stock at an agreed upon price and date. There are two types of options: puts, which is a bet that a stock will fall, or calls, which is a bet that a stock will rise. One contract represents 100 shares of the stock. So when you buy an option, whether it's a call or a put, you're not buying stock. You're buying a contract that controls 100 shares of the stock that gives you the right to buy or sell at the strike price, right? And when it says buy or sell, so when you buy a call, you're long. You're long the stock. If you buy a put, you're short the stock. So an option in Robinhood, you can up in the top here, it says buy call, buy put. You can. I'm not gonna go through shorting options and that kind of thing. I have other videos on this channel that will go through the different strategies like spreads and all that. Right now, this is just the basics, and we're just going to cover buying a call and buying a put. But up here it says Apple call. You can click on this and hit buy Apple put, and it'll switch it over. So you can switch between calls and puts up here. It's the same exact thing on mobile. Okay, so we'll just go through one at a time here. It says call options are an agreement that give the option buyer the right, but not the obligation, to buy a stock at a specified price within a specific time period. The stock is called the underlying asset. So we're not going to worry about bonds and commodities and stuff like that. We're pretty much just going to talk about the stock. I probably should have edited this definition a little bit here. The stock is called the underlying asset. So think about it this way. So it gets a little tricky to understand, but once you understand it, it'll really click, right? So the stock is trading at whatever the stock price is. The option is trading on top of the stock price, so that's why the stock is called the underlying, because the options have their own set of numbers and what they trade at, what their value is at, but it relies on the underlying, which in this case is the stock. And then it says a put, pretty much the same thing, but it allows you to, instead of being long, you're short, you know. So the strike price, and this is where it said here, like if you're looking at the call here, it's saying the call options are agreement that give the option buyer the right but not the obligation to buy the stock at a specified price. And what that specified price is called the strike price. So if you're looking here on Robinhood, this is the strike price here. This is the strike price. Strike price is the price at which the derivative contract can be exercised. The term is mostly used to describe stock and index options. For call options, the strike price is where security can be bought by the option buyer up till the expiration date. For put options, the strike price is the price at which the share can be sold or shorted by the option buyer, right? So you're like, man, this is a lot of information. This is confusing. I'm trying to go slow. I'm trying to keep it simple, right? I'm trying to keep it simple. So let's go into what that kind of even means. You know, I wouldn't pay right now. I'm not going to pay too much attention to the break-even price. I have another video based on what the break-even price is. I would say ignore break-even and to break-even columns right now when you're learning. You know, and if you're just learning what it is and how options move. So the strike price, so you're like, hey, what does that mean? Do I get questions all the time. Is like, hey, if I buy an option, do I have to wait to the expiration date to sell it? That kind of thing. And you can, if you buy an option, you can buy it or sell it at any point in time before the expiration for profit or for loss. So you don't have to hold on to it till expiration to get your profits. I know it's a little bit confusing. So, you know, here's all the expiration dates here that it's available through Robinhood right now for Apple. And unlike stock, options expire. So they expire. There's a date on them. That means you have to be right within the time period that you select. So if you think that Apple is going to be higher than 170 by February 22nd, which is next Friday, then you would want to buy the 170 call option, right? Because you think it's going to be above 170 by next Friday. So when you're buying and selling options, there's a lot of things that you need to account for. The stock price, how much you pay for the option, and are you going to be right by the time it expires? And we're going to go through, you know, really why that matters. So I'm going to click on this just because I've been using the example, the 170 strike price here for the call. Okay. Now, when it said here, strike price is at the price which derivative contract can be exercised in. So what does that mean? So at the beginning here, I said one contract equals 100 shares, right? So right here under stock option, one contract represents 100 shares. So when you have 100 shares, when you have one contract that controls 100 shares, the strike price can be exercised. The strike price can be exercised once it's above, let's say 170, the strike price. So for the call, the option contract can be exercised if it's above 170. And if you're buying options, you'd be the one to exercise this. But you're like, let me get the calculator out here. But understand this: when you exercise an option, you lose the price that you pay, and you have to buy 100 shares of the stock. So if you exercise it, so let's say by February 22nd, Apple was 175, and you're like, hey, I want to keep this going. I want to hold the stock. So if you do that, if Apple's 175, you're going to be able to buy the stock at 170 because your contract says, hey, I'm allowing you to buy the stock at 170. It doesn't matter if Apple's 175, 185, or 195. You're given the right with this contract to buy the stock at $170. So it doesn't matter how high Apple goes, it can go to the moon and you would still be able to buy stock at $170. But the catch is you have to have the capital to buy 100 shares of Apple at $170, and that's probably $17,000, right? So 170 times, yeah, $17,000. So you would need $17,000 in capital. You know, you most likely wouldn't do this. You know, most people would, you know, if Apple went up to like 180 by February 22nd, your call option is going to be worth a lot more. So most people would just take the money. This, you know, exercising it is rare. You know, options traders mostly just trade the options. They don't exercise for the stock unless you like plan to hold till like for 5 years or something like that. Like if you're like, man, this really is taking off and I really want to hold this, then, you know, but the catch is you have to buy 100 shares. If you don't have the capital, you can't buy it. You cannot buy it. So you lose what you pay for it, but you're able to hold it, so you're able to exercise it. And you know, if Apple goes up to 180, like I said, or 190, and you know your options are going to be worth like $1,000 or $2,000 versus $200, so you're probably just going to take that. You know, because some people get confused, like, well, if it goes up to 180, you know, isn't it better to exercise and then take the profits? But in reality, the option pricing does reflect in how much it increased. Okay, so let's go through some of these other things here. There's quite a bit of information here. Bid, ask, mark, previous close, high, low. We've got volume, open interest, implied volatility, and let's go through that. Let's first talk about the option price. So it says $2.45, right? $2.45. You're like, hey man, that option's only going to cost, if I buy this one contract, it's going to cost me $2.45. That's not the case, because one contract equals 100 shares. You have to multiply this number by 100. So instead of it costing $2.45, it's going to cost you $245 to actually place this trade. So if I click on this and hit continue, you know, it says 245 here, but if you hit one here, it's gonna say max cost $245 to get kind of give you the understanding. So even though the limit price here is $2.45, it's going to cost you $245 because one contract equals 100 shares. So you multiply it by 100 basically. Okay. And the bid and the ask, if you're familiar with stocks and options, works just like or if you're familiar with stocks, the bid and ask works just like the stock's bid and ask. You know, the bid is how many people are how many people want to buy it. The ask is how many people want to sell it, and then the mark is the mid price. They call it the mark on Robinhood. It's the mid price. So it's the difference between, you know, the bid and ask. So 242 and 247. The mid is 245, and they actually give you that right here, as you can see here, up in the upper right here, the limit price. So, you know, the bid is 242, the ask is 247, and then we have the mid price. And then it shows you what this option previous closed at and what the high was yesterday. Since the market's closed right now, this is what's saying what the high was, and this is what the low was. Volume is how many were traded per this strike. So this volume, it's not the volume for the stock. It's not volume for all the options. It's only for this strike price. So the 170 strike price was traded 64. The volume was 6,400 ish, right? And then if you go to this, see it's different. The 172.50s has 9,000 volume. So when you want to trade, when you're looking, if you're new to options, you definitely want to trade something with high liquidity. When I say high liquidity, it means high volume, and this is 9,000. So you want to play like Apple, SPY, Netflix, stuff like that. You don't want to trade like stuff that has a volume of 10 or 20. You know, you want a volume of at least 500. You know, and then also because you want to have a nice tight bid and the ask. So for like the 172, the bid and the ask is 4 cents. Here it's 5 cents. You know, on SPY, SPY, you can get in bid and ask within a penny of each other, and when you're new to options, liquidity is everything. And even if you're not new to options, I mean, liquidity is still everything. Okay. And open interest means how many people are currently holding this contract. So even though 6,400 were traded, so that's like open and closed, right? There's 55 open contracts. There's 55 open contracts that people are actually holding right now. Okay. Delta, we're going to talk about delta, and we're going to talk about theta because those are the two factors. So how they impact your price. So it's not, options trading isn't that simple where the option, you buy the option, the stock price goes up, and everything is okay. It's not like that. It's not like the stock. Like when you buy a stock, let's say you buy a stock for Apple at 170, it goes up to 175, you sell it for 175. However, there's other things at play here. Implied volatility and theta are huge factors in terms of being able to sell it for more than you have. So there's a lot of things working against you, or they could be working for you depending on with you. So when you're buying and selling options, you want to do it in terms of, you want to capitalize on the strength. And what I mean by that is, let's talk about theta. I'll do delta last, and we'll talk about implied volatility. Theta is a measure of the rate of decline in the value of an option due to the passage of time. It can be referred to as an option's time decay. If everything is held constant, the option loses value as time moves closer to the maturity of the option or expiration date, right? So what does that mean? What does that mean? You're telling me that if I buy this and Apple's stock price stays the same price, my option's going to decay? Like, is that what you're saying? And that's exactly what I'm saying. So theta right down in here is negative 15 cents, give or take, a little bit, like almost 16, but whatever. We'll just say it's 15 cents. So if the stock price stays the same, this theta burn is on a daily basis. So my option will lose 15 cents per day, or $15 per day if you multiply by 100, $15 per day. If the stock price right now, the share price, you can see right here, share price is $169.95. Let's say the share price, is at 170, give or take a little, a buck or two up or down. That's the case. So, if it stays right around here, if the share price stays right around here, theta is saying that I'm going to lose 15 cents per day, $15 per day if I buy this. So if tomorrow, right now it's $2.45, $2.45. Tomorrow we wake up, stock price is still like 170. This should be worth around $2.30, give or take, However, these numbers down here, like theta and delta and implied volatility, they're not static. And the closer that you get to expiration, the higher the rate of theta, the higher the rate of acceleration. So like just because just because this 170 call is negative 15 cents now, tomorrow, if the price stays the same, this might even be like negative 20 cents. So it's not always the same. So that's why I say there's a lot of factors when it comes into option pricing. It's not just you buy the option, you hope for the stock to go up. There's a lot of these factors will, definitely determine if you're going to be profitable or not profitable. And, this, meanwhile, as you're holding this and the stock is staying the same, this actually just updated right now to 16 cents. So you see this yesterday. So yesterday, actually, when I was looking at this, it's now, we got about an hour to market open. They just updated this. So yesterday it was 15 cents and now it's 16 cents. So just to show you kind of how that works, it was kind of interesting that it's updated right now. Kind of weird, but went from 15 cents and now it's 16 cents. So you can see how those numbers can change. Also it'll also so this theta will definitely is a major factor in determining, are you going to be profitable by February 22nd or not? And you kind of have to do the math. Like how much does the stock have to go up in order for me to be profitable, even if there's a theta burn rate. Let's say the stock is flat today, flat tomorrow, and then this instead of being 245 in like 2 days from now, it's probably gonna be like $2, right? It's gonna be $2. So you lost $45 just because the stock was stagnant, is really what that means. Okay. Delta. Go here. Delta is a ratio comparing the change in the price of an asset, usually a marketable security, to corresponding change in the price of its derivative. For example, if a stock option has a delta of 0.65, this means that the underlying stock increases in price by $1. This means that if the underlying stock increases in price by $1 per share, the option on it will rise by 65 cents per share, all else being equal. So this determines how much, basically, if Apple goes up. So if Apple goes up from 170 to 179, you're going to make 49 cents. So instead of it being 245, you're going to be, it's going to be, if it goes up to 171, you're going to be at basically almost $3. It'll be at like 255 range, 254. It'll be at like 254. So you can kind of calculate that. So it's good to understand like what your delta weight is, and you can also pick things that have higher delta. Like more when you go more in the money, and I'll explain that in a second. But if you check these other ones like 165, this delta is 175. This delta is 71 versus the 170 strike. The delta is 49. And you kind of have to play with the numbers. This delta is 80, but obviously there's for 160 strike, but obviously this option costs you 245. This one costs you 1105. So like, there's no free money in the market. There's no way to kind of game the market to kind of make, you're always going to have to incur some sort of risk. People think like, oh, I found this strategy, it's amazing. I take on zero risk and I can make money. And if it's a zero risk trade, you're not going to make money on it. I guarantee it. If it's a zero risk trade, the way that trading works, the way that investing works, is you have to take risk on your part, just like anything in life. You have to take risk on your end to get rewarded. So, to get the higher delta, are you willing to risk more money? It's pretty much how it works. So, the one thing that I will say is, so you can kind of calculate this. So if it goes up to 172, so if we're talking about the 170, if it goes to 172, let's say this is going to go up about $1. So this will be worth like 345, and you'll make $100. Not bad, But you have to work the numbers, because if you just buy and hope, it's probably not going to work out for you, because what if you buy this option and Apple has been flat for days, and there's no sign of it stopping? Then you just basically spend $245 and watch yourself bleed out. If you're gonna, and if that's the case, maybe pick something further out. Maybe pick 3 weeks, a month out. Whatever the case is. Obviously, the further that you go out, the more expensive they get. So if I went from February 22nd to March 15th, the option pricing here is 485 versus in February it's 245. And why is that? Why is that the case? It doesn't tell you here, like other brokerages will tell you like the percentage chance of it being in the money. And because it has more of a likelihood, the reason why it's more expensive for March 15th, it has more of a likelihood to be in 170 by March 15th than it does be 170 by February 22nd. So, when it comes to options and it comes to trading, it's all about probabilities. What's the probability of it being at 170 or above by February 22nd? And the reason why it's saying it has a greater probability by March 15th, this is why these are more expensive, is because there's more time. You get it? So less time if you're buying cheaper options and there's less time to do it in, you're inheriting more risk. If you're buying something further out, you're paying more, but it's less risky. So I hope that makes sense to you. And then I want to talk about in the money, out of the money. So when I say in the money or out of the money, so if you check this line here, it's saying share price 169 165. So this is on the call side. Anything below, so if the stock price is above your strike price, that means you're in the money. So, you know, these are in the money. So 165 and 167.50 and below, you know, because the share price is 169, so the share price is above. The share price is above for calls. The share price is above my strikes. That means I'm in the money. And when you're in the money, theta and everything is going to impact it differently. A higher delta, theta is going to be different. You know, so like for instance, theta and delta, I would say, you know, for this it's let's say for the 170, you're going to be getting 60 because it's out of the money. You're paying 16 cents now in theta, versus here, you know, you're paying 18 cents and you're inheriting more. You know, it's 420, but you're getting a higher delta. So you kind of have to play with the numbers and see what the stock's going to do. You know, in implied volatility, it means when there's like low implied volatility, the options are going to be cheaper. Higher implied volatility means the options are going to be more expensive. And you're like, what is implied volatility? It means how much volatility is this strike going to experience? Is it going to be, you know, is Apple going to be going up and down? Is it like 25, pretty low volatility, so they're not expecting Apple to do anything crazy? Like 50% and above is high implied volatility. There means they're expecting the stock to move around quite a bit. Like 25% is pretty low. However, when it's low volatility, implied volatility, you're going to get cheaper options, but you're not going to get as big as moves. And then when it's like, if let's say implied volatility is over 50, you know, this option could be like $4. It could be double, but Apple's expected to move more. You know, instead of let's say Apple right now, let's say implied volatility is saying it's going to move $2. You know, when it's like 50%, maybe it'll move like $4, $7, $8. You know, so there's always when you're trading options, it always comes down to your risk and your reward. You know, how much risk are you willing to put on the table for how much reward are you going to get? And you know, I know we covered a lot of information, but I definitely hope that, you know, so far we've been answering your questions. If not, leave a comment below. Same for puts here. Now puts, you know, let's recap just in case you forgot. Calls you want to be long. Puts you want when you want to be short. So if you think the stock is going to go down, you buy a put. If you think the stock is going to go up, you buy a call, right? And it works the opposite way for in the money, out of the money. So in the money, these are in the money when you're going up here. As you can see, you can, and if it gets confusing based on this layout, you can tell that it's in the money as it's getting more expensive, versus out of the money when it's getting cheaper. And the reason why it's cheaper for out of the money and in the money, because it has a less of a chance, it has a greater chance of Apple being 175 than it does, you know, 144, you know, for the puts. You know, like, so when you're buying a put, you want the stock to go down. So instead of like the call side, so you want this to kind of move down this way, versus on the call side, you know, you want this line to move up this way. So as you can see how that flip flop. So these are more expensive and getting more expensive versus up here, and then the put side, these are getting more expensive versus the ones down here. So it flip flops. So it makes perfect sense that, you know, when you have a call, just think about this line here. When you have a call, you want this line to go up. When you have a put, you know, you want this line to go down. You know, so you can do the math this way. And the way that puts work is it's the exact same thing. They also have delta, they have theta, they have implied volatility, they have volume, they have gamma. I mean, they have all this stuff. So I'm not going to cover all that again. You can. It's the same exact numbers, and it impacts it the same way a call and a put. You know, there's instances where the option pricing may be skewed, like calls are more expensive than puts, and puts are more expensive than calls for the move. And that's because when that happens, it's because the market is thinking the stock has a greater chance of going down than it goes up, which it gives you, you know, it could be opportunity. I'm not saying this happens all the time, you know, but sometimes people think it's, you know, the market thinks it's going to go down and then it goes up. And then at that point, you got a really good deal on calls. Like when you're buying and selling options, it's all about scouting for good deals. Like if you overpay for options, you're most likely going to lose. You're most likely going to lose because you overpaid, and then theta and implied volatility is going to eat away your option. And as you get closer, you know, it's kind of like in life. Like, you know, when you go buy a car, do you go to just any dealer, or do you go online and say, okay, these guys, you know, it's the same car, but this one's cheaper, this one's better, this one has lower mileage, this has leather seats, blah blah blah. You know, it's the same thing. It's the same option. But I mean, maybe theta was too high, maybe implied volatility was too high, maybe, you know, and you kind of have to use your own judgment, and also, you know, use math. I mean, it requires work. Trading options requires work. So let's talk about real quick about getting exercised and the option. And in Robinhood, they actually, if you're riding close, let's say today was February 22nd and your option was in the money or close to in the money, 1 hour before close, they'll actually sell it for you. And the reason why they do that is because a lot of new options traders get in trouble and they let their options expire in the money. And, you know, let's say today was February 22nd and the price was 169.89. You know, anything like these calls, these 167.50s and below are all in the money. And let's say I was going to ride it till expiration, and there would be really no reason to do this. So Robinhood wants to mitigate risk on their end, because they don't want to, like, most people don't have the amount of money to cover 100 shares of Apple, right? And that's what happens if it expires in the money, it gets exercised, or meaning that you have to then buy 100 shares, which is like, well, if you have $1,000 in your account, you don't want to take you don't want to make a 17,000 purchase, nor can you, you know? So unless you're on margin, but we're not going to talk about that. I mean, don't trade on margin. It's you know, we don't need to talk about that, but you get what I'm saying. So, you know, people get very confused. What I say is, if you're trying to trade options, just trade the options. Don't try to convert it into stock and get all crazy with it. Just, if you're profitable, take the money. If you're losing on the position, mitigate risk, play some defense, you know, switch it up. There's a lot of ways. I'm not going to go through it. I have a lot of other videos that will talk about different strategies, but this one's just kind of going through the basics. But so if anything's in the money, which we talked about before, if anything's in the money, it's subject to get exercised at expiration. However, Robinhood won't if you don't have the money in your account, they won't let you, they'll sell it for you 1 hour before close. And I say, I would definitely close. If you don't have the money to get exercised and you don't want to exercise it, don't put it in Robinhood's hands, because they just sell it just to mitigate the risk. They don't think about your best interest. They don't think about, hey, what's good for you, Joe? Is this good? Is this a good price to sell it at? No, they say, hey, there's risk on the table. We're going to remove this from Joe so that way he doesn't have to worry about the risk. And also, we don't have to take risk as a brokerage, is really what they're saying. So best advice, I think, take your profits, then redeploy them, buy another option further out as soon as you get it, you know, and don't risk assignment. Don't ride this 167.50 all the way to expiration, because also, as you get closer, like if you're like an hour away from expiration, theta is going to be super accelerated. I mean, if it went from 169, as you guys know, with the volatility in the stock market, if it went from 169 and you were at like $4 and it cut down like $2 down to 167, it's probably going to be worth like 25 cents, maybe 10 cents, like right into close, or maybe 50 cents, you know, who knows. So you go from like $4 or $3 down to 50 cents in minutes. So not only riding to expiration is very risky, but there's also like theta and everything is very, very accelerated. Any down move when you have a call, you'll start losing a lot of money. Yes, you could make more money and, you know, whatever, but you have to understand your risk. So riding it to expiration, you know, 1 hour before close, Robinhood is going to close it for you automatically if there's a buyer for it. So the way options work is there's, you know, just like the stock market, there's a buyer and then there's a seller. You know, if your option is up here like 235, there's probably not going to be a buyer for it. It's going to expire worthless. So if you bought something up here, like, you know, they're 1 cent now, you know, and you just wasted $1. You know, and you're like, well, you know, people are like, oh, well, you know, I'll buy $1. I'll buy this for $1, and if it goes up to 235, you know, I'll make thousands of percent. But how, that's lotto playing. Like, how many times is it going to take you to actually get that hit? It's going to be very rare. You're going to want to buy something that's closer in the money because your probability of making profit is greater. So I hope that kind of resonates with you. There's a lot of people that lotto play these little dollar ones here, and sure, Apple could go up that high. It could, it could. But is it likely to go to like 235 by February 2nd, 22nd, 1 week from today, and the stock price is 170? It's not likely. You want to, when you're option trading, you want to focus on higher probability and profits, and when you're closer to in the money, you have a higher probability of getting there. You have a higher probability of making money. And that's the goal. When you trade options, you want to make money. When you trade options, you don't want to lose money. So why increase your risk by buying stuff like way out there? So just my 2 cents regarding that. Excuse me. So in terms of just to kind of recap, and it looks like we're moving up here a little bit pre-market here for Apple. Just to recap, we just covered the call, the put, kind of the basic definitions. If you have any questions, definitely leave them below. This is just like a really introduction, basics to options trading on Robinhood. I also have a lot of other videos regarding, different strategies, whether buying options or shorting options. But, for a newer trader, you don't want too much information. You kind of want to let it sit, kind of resonate, kind of grab a hold of it and use it to your advantage. So I hope it helped. It's always us versus herd. Stay safe, stay green. If you have any questions, leave it below. If this video was of value to you, hit like. If you want to subscribe, great. And we also have links to our free options trading group and Discord below. So if you're interested in that, we'll see you next time.